am so happy to be here today, and I am so happy that you women are here with us. And our goal, as you always know, is to make it a golden day. And I've been having some questions as why do we host these webinars? Why do we have these? And what's our concept of why we want to do this? And I wanted to share that. The basic reason that we host these webinars is because we want to make a difference in women's life. We want to share information that can maybe help them better their world. And when I say basic information, I mean, this is information that we as women are going to have to deal with, but we've never been given that opportunity to get information on it or to get an explanation of how it all works. Normally, we're just blindly start into it. And when I talk about blindly starting in, I'm talking like, credit cards. Oh, all of a sudden you have credit cards. No one's ever went through how compounding interest works or how these things work. So the more informed we are, the better decisions we can make, and the more advanced we can use it for our good instead of it hurting us in the background. We do the webinars so that we can build women up. We want to give them knowledge and resources to empower them to be the best person they can. When we make decisions based on knowledge, even if it's limited, it's better than just moving through life and doing what everyone's doing because that's what you're supposed to do. And then for those of you who know me or familiar with my story, my personal story, I felt financially trapped for years. I do these webinars as a pay it forward type of thought process. And my hope is that it will maybe shorten the learning curve and the correction time for other women. The things that took me years to figure out and years to get in place to correct my financial path, I'm hoping that we can do that faster for the women out there. I help women learn about their finances and how to make their money work smarter for them. I set up safe money options. And once we determine what would be the best option for them, that's when we put it in place. And it might be through life insurance. It might be through annuities. It really depends on where they're coming at in their point in life. So the webinars allow us to share with many at once and give them the information to start figuring out what's my next step. And that's why I wanted to have special guests on our webinars at times so that we can get in different arenas that aren't even my strong point, so to say, all the time. There's a lot of areas that aren't necessarily my strength. So I want to share that with women and have that as an area that we can share also and grow. And I'll tell you, Stephanie has been phenomenal in bringing me along and helping me grow on that side, because this is her expertise. This is where she shines. So let me see if everyone can see my screen. I want to share my screen. Can you see, Stephanie, are you seeing the screen or are you seeing my side of it?
I can see your screen.
Okay. And you see the full screen of the...
No, I'm seeing sort of the presenters section.
Okay, let me share. You guys don't want to see that. It's got all the marks and junk on it. Let me actually share this one. Okay, now do we see a full screen?
Yes.
Excellent. So we're going to talk today, and this is why I want to bring Stephanie on. We're going to talk about how to make the tax season less taxing. And first, I want to share a couple interesting facts with everybody, or at least I found them interesting, but I kind of nerd out sometimes. Tax was created to cover financial requirements from the Civil War. So in 1861, Congress placed the first flat tax of 3%, and that was on for anyone who made over $800. The 16th Amendment established Congress's right to impose federal income tax. That was passed by Congress in July of 1909 and ratified February of 1913. Now, this one blew my mind, and I actually had to look at different sources. And Stephanie, you are probably going to know where I'm going with this, because there were so many different numbers out there. But from the most sources I got, the U.S. tax code is 6,871 pages, and that goes to approximately 75,000 pages when you add in and include the regulations of the official tax guide. And that's exactly why I wanted to bring Stephanie on, because never ever put yourself in a situation where you have to be the expert when it's an area that's not your field of expertise. Stephanie began her career at Stowe Johnson LLC in October of 1997, became a partner in January 2008. She has a bachelor's degree specialized in studies in business law from Ohio University, an associate's degree from Rhodes State College in Lima. She's an active member of the Ohio Society of CPAs and the AICPA. She serves as a treasurer for the West Side United Methodist Church of Wapakoneta. She serves as is it also a treasurer for the Wapakoneta Downtown Partnership for Children's Hometown Holiday?
Yep.
She's also an officer for the Board of Equestrian Therapy Program in Cridersville and serves on the Huntington Bank Advisory Board. This is an active gal. This is someone who is very busy, and we thank her for taking time with us. She's also active in 2 counties, women of business groups. So she's also trying to help other women. And that's what I have always admired Stephanie for. She's a wife, she's a mother, she's a successful businesswoman and friend. And ladies, it is my pleasure to have Stephanie Shutt-Steinke join us today. Stephanie, thank you so much for being here.
Thank you for having me. I greatly appreciate that. And I appreciate that introduction. And Kelly and I have known each other for several years now. And when she first told me about this kind of, I guess, a mission that you have for helping women, that I immediately had a passion for that. And just because I do think, that there are certain aspects that women are dealing with sometimes, or maybe haven't been exposed to, that and sometimes actually we just relate better to women. Does that make sense? We go in to talk to somebody. Sometimes our doctors are women, we tend to gravitate sometimes toward women. And so I was extremely happy to just volunteer my time today to talk about anything I might be able to bring to the table with the taxes. I am a CPA, so I'm with Stowe Johnson and Company CPAs, and we do lots and lots of taxes, business taxes, personal taxes, and all different kinds of planning for that. And so I know that, as we're heading into tax time, this is just something that's kind of top of the mind for a lot of people about, it's tax time. What am I ready for tax time? What is the IRS looking for? Am I doing something I'm not supposed to do? Should I be doing something else? And so that's just on the top of our mind when we get ready for tax time. So with that, are you ready for me to jump right into my PowerPoint here? Or
go ahead.
Okay. All right. Can you see that screen okay there?
Yes.
Okay. So, and let's see here. Okay.
We see your thumbnails on the side too. Oh, they're gone.
Is that good?
Perfect.
Okay. All right. Very good. So we're just kind of talking a little bit about tax time. The 3 kind of key points that Kelly said that on her webinar, she kind of uses some three key points that people might want to be, take away from the presentation and might want to gain. And so the 3 key points that we're going to talk about today are, what can I deduct on my taxes? Now, we're not going to talk about business tax today. So if you are a business owner, or if you have a business, that is kind of a different topic, but I'm always glad to answer something on that if you guys have a question on it. But we're mostly talking today about personal taxes. What can we deduct on our personal taxes? And what might we be looking for when we're getting our tax return ready to go, whether we do it ourselves or whether someone's going to do it for us. And then the second kind of interesting tidbit that I kind of wanted to go through with, every year Kiplinger issues, Kiplinger is kind of a finance magazine type of thing. And so every year they issue some different guidance on just tips about what does the IRS look for and who are they auditing. And so we've had, as you can imagine, we have IRS audits here at our office. And so I have a little bit of insight as to what the IRS might be looking like and what it's like to kind of go through an audit. And what that seems like on the other end of it. And then the third topic would just be, do I need an accountant to prepare my taxes? Can you just do your own, or can you go to TurboTax and do your own? Should you have an accountant? Who needs an accountant? And so we'll kind of go through those topics today and just to get the highlights of those. The first thing I think, though, that everyone really kind of needs to understand is what your tax return looks like. And I always kind of just equate this to your stove and the burners on your stove. So if you think about it, you're getting supper ready and you have all your burners on, you got pans on every burner. That's all still your stove, but there's different things in different pots on the stove, and you're doing different things with each one of them. Well, it's kind of the same way with your tax return. It's all your tax return. There are lots of pages on it, depending on what you're doing. But each one might be handled just a little bit different behind the scenes and might be taxed just a little bit different than something else. And so it is pretty hard anymore to do taxes by hand. We occasionally do see somebody that's doing that, but most anymore, just because of the way that different things are handled behind the scenes, most times we do see people doing something, electronically, either through a paid preparer or through TurboTax or through the IRS website. They have some free service there as well. And so it has gotten to the point where it's back to the 75,000 pages that Kelly was talking about there in the introduction. It truly seems like it sometimes, and there are just all kinds of things going on with it. So it's kind of hard to do it by hand. But the idea being that you have your tax return, and you might have different kinds of income coming into your household. You might have wages. You might work at a job. Your spouse may work at a job and has wages as well. You might have a rental. You might have other kinds of income, like you might have won some gambling income or gaming or lottery or something like that. Then you might have, if you're retired, you might have IRA income. You might have interest, dividends, capital gains. And again, these are where some of these can be taxed just a little bit differently behind the scenes. And then if you have a business, you might you have business income, and all those things come together and they go on your tax return and you basically, even though they might be handled a little different behind the scenes, they all just get kind of added together. And so that's going to be your total income on your tax return. And you might say, well, why is this important? And it's important because it's going to go into how your taxes are going to be calculated. So I kind of threw an example here on the screen here of a married couple, two different married couples. One has no children, and then one has 2 children under the age of 17. And so in the key number that we're looking at here as we go along is this information in red, which is called the standard deduction. But both of these couples will start out and they both make $90,000 a year. So they both work, or maybe one of them works, but they're bringing in $90,000 a year of income, maybe from anything in that circle we just talked about and had that picture in the previous slide. So if they have $90,000 of income, it doesn't matter what kind of personal deductions they have. Now, we're talking about personal deductions, not business deductions in any way, but personal deductions. It doesn't matter what personal deductions they have. The IRS is going to give them a standard deduction of, in this example, $25,900. So they're going to automatically get to deduct that no matter what kind of deductions they have on their own. And that's going to become important here in a second when we talk about what you can deduct personally. So in this example, they have taxable income of $64,100. And then they have tax of $7,200, so they're the same there. And then now, under the rules that we have now, there's something called child tax credits. And anybody here that had children on last year may remember there was like advanced child tax credits and there were extra child tax credits and there were all these things. But for 2022, it's pretty straightforward. And so in this example, that the one couple ends up with $7,200 of tax and the other one ends up with $3,200 of tax. But the real key here is this thing called the standard deduction. It's what the IRS already gives you as a deduction. So that's what you're going to get regardless of if you have any of your own deductions. Now, so then you come along and you say, well, what about my deductions? I have deductions. I own a home and I might have mortgage interest, and I own a home, so I have some real estate taxes. Here in Ohio, we have Ohio tax, we have school tax, we have city tax. I know down there in Florida, you guys don't have a lot of that stuff, but so you would have those things. And then charity, we know about giving. Most of us know if we give money to church or give money to a nonprofit, that's going to be a tax deduction. And then there is also a deduction for medical expense, but it's kind of limited by the amount of income that you have. Before 2018, there was also something called an employee business expense, which, like if you had mileage or you had some out-of-pocket expense that you were incurring for your job, you could also add that into this. They have since eliminated that. So that has been a big hit to a lot of people. Mileage was the big one. There was a lot of people that deducted mileage that maybe they weren't getting reimbursed for. But that's been eliminated. So right now we're down to basically mortgage interest, taxes, charity, medical, those type of things. So if you think about the average person or the average home, maybe they have, for example, $4,000 of mortgage interest, and they might have $3,000 of real estate taxes. Here they have a couple $1,000s to charity. So altogether, or at least this is the average people we see here in Ohio. And you're going to be, in California or New York or some higher places, maybe these numbers are bigger, but let's just say this couple has $9,000 of deductions. Well, if they have $9,000 of deductions, and the IRS is going to give them $25,900, it's kind of a no-brainer that they're going to take the higher IRS deduction because it's more of a deduction, and it's going to mean they're going to pay less tax. So in this example here, instead of taking $9,000 of their own deductions, they would take the IRS deduction of $25,900. So it's going to be better to take the IRS number. So what we end up in a situation of is that even though these things are tax deductions, even though you have mortgage interest, even though you have real estate taxes, even though you have charity, medical, that a lot of times you just don't get to really take advantage of them, and they don't save you much money in tax. So we find ourselves in a situation that those don't really so much matter. So even if you doubled these numbers and you had $8,000 of mortgage and $6,000 of real estate tax and $4,000 of charity, you'd still only have $18,000 of deductions, and it would still be better off to take the IRS deduction. So we just find ourselves in a spot where these things don't matter as much anymore, and they're not, even though they are tax deductions, they're not really beneficial. So then I guess you might, say to yourself, okay, well, what am I gathering for tax time then? And I guess the point of that is most people are probably anymore not gathering much on the deduction side of their taxes. They're going to be looking more to make sure that they are reporting all their income, that they have picked up everything that they would have, and that they're strategizing maybe about Roth. If you were on a little bit early, Kelly and I talked a little bit about Roth conversions and different things that people might be strategizing on that point with, but they're not as much looking at the deduction side of it anymore. So Kelly, did you have a question? Yeah or no? I think you're still on mute.
There we go. I just wanted to interject, this is exactly why we wanted you here today. Thank you so much, because this is good
Okay.
And if people have questions, please go ahead and throw them in the Q&A and we'll try and get to them at the end. So sorry, Steph, I didn't mean to interrupt.
No, that's fine. Okay, so with that, we are going to switch gears a little bit and talk a little bit about what does the IRS look for? What would be on your tax return that would maybe flag your return a little bit to be picked for an audit? So I guess I want to talk a little bit about IRS audits. We do obviously have had IRS audits here in the office. But a lot of times what the IRS is doing now is they are going into something called a correspondence audit, meaning they will pick one or two things from your tax return and they will just send you a letter and say, hey, we're auditing line 64 of this, please send your proof in for this. And so those are fairly simple to respond to. You just basically send in your proof of what that is, and hopefully that resolves it, and then you're done. We do occasionally run into full-blown audits where the IRS auditor will come into the office and actually sit down and go through quite a bit of the return, but it's really rare anymore for the entire return to get picked. Back in the day, years ago, when I first started in this profession, they would audit the entire return, and we would go down to the IRS audit or office here locally, and we would sit there all day, and I'd have big boxes of documents, and we would literally have to pull out and justify every single line item. They have obviously realized that that probably isn't beneficial or effective, but they we do get a lot of correspondence audits, where there's something on the return that kind of highlighted to them that something wasn't right. One example that comes to mind, I had a client who was in the business of they were in a business where they traveled a lot. Their team traveled a lot. So they didn't have a lot of other expenses other than travel. So on their, if you can think about their business, they had a lot of income, but then not a lot of expenses, but then their travel was like, I don't know, $300,000. It was a lot of money. And so that got selected for audit just because compared to all the other expenses and everything else going on, it just seemed very high for travel. And so that got picked. And we've had other examples, same thing, where clients had just like kind of an unusually high number of something. And so then that has got selected for audit. And it doesn't mean that necessarily you won't pass the audit. It just means that you're going to have to provide the proof on it. So with that, we're just going to kind of flip through what, and again, Kiplinger, which is the finance people, they kind of issue this every year. And it's kind of just the highlights of what the IRS, what might be prompted to give you an IRS audit. So as you're preparing for tax time, it's just something to be top of the mind and kind of think about. But some of these we're going to go through very quickly because obviously there's 23 of them. But the first one, though, is just failing to report taxable income. And as you can imagine, behind the scenes now, all these places like Kelly's things that she does for you and all these other brokerage firms, things like that, they all report that information to the IRS. So if you forget to report a stock sale, if you forget to report your interest and dividends from something Kelly's doing for you, from that financial aspect, if you forget to let's say you did some contract work for someone and they issued a 1099 on your behalf and you didn't pick it up in income, they're going to let you know that's all matched behind the scenes with the computer. So they're going to let you know, hey, we're changing your tax return. We think you forgot to report this income. So sometimes that's explainable, and sometimes honestly people just forget it. So make sure that if you're not sure if you're getting forms from Kelly at the end of the year, the companies that she's working with, that you ask her, will there be tax forms coming for that? And make sure you don't file until you get all your forms that you're going to be having. Making lots of money, higher income people typically get audited more. So that is, I guess, not a bad thing, but it is something to be aware of. And then number 3, what we talked about just a second ago, taking higher than average deductions, losses, credits. Occasionally we'll just get someone that has a really incredibly high number on something, and that is an audit flag, something to be aware of. Taking a really large charitable donation could be a flag. And you probably don't run into this much down there, but donating conservation easements, that is, we're in farm country, so occasionally we do get into some of that, but where you would actually donate some of the use of your land for conservation. Running a business, there's obviously more to claim there. Claiming rental losses if you have some rentals. And if you just don't file your tax return, that can be a flag to the IRS that something is wrong if you're just not filing. And occasionally we get someone that walks in the door that hasn't filed for 6, 7, 8, 9 years. It's honestly, it's kind of crazy sometimes, but sometimes I think it's almost the fear of the unknown. Sometimes people are they didn't file for a couple years, maybe had some things going on, and then they got scared that it was snowballing too much, so they just continued not to file. And so if you find yourself in that situation, I just encourage you basically to take one bite of the apple at a time, get one return filed, then another and another, and just kind of chip away at it. But hobby losses can be a big flag to the IRS. There's a big difference in the eyes of the IRS between a hobby and a business. A hobby might be something that has some personal pleasure to it. So one of the big hobbies we find are race car driving. Horses are a big one because they're very expensive, but there's a personal nature with it. But then we also find it it is possible to see it in other things where someone will say, well, maybe they were doing some crafts or something like that, or whatever, maybe, and it's not really, it's more of a hobby than a business. The IRS actually looks at, did you have a business plan? Did you consult professionals to figure out how to make money on this hobby? Or not hobby, this was it a business? Did you have business cards? Did you have invoices? Did you run it like a business? Did you have bookwork? Did you have, webinars? Did you present it as, something that was of a business? So they do look at all of that to see if you were running a business or hobby. And the reason that's important is because in a hobby, you don't get to deduct, you have to pick up your income, but you don't get to deduct any expenses. So that's a very big distinction in the eyes of the IRS, because if you're running a business, you obviously get to deduct all those expenses. Claiming 100% business use of a vehicle if you own a business. We always tell people it's good, especially like with cell phones or cars or whatever it might be, to just acknowledge there's some kind of personal aspect of that. Maybe make it 90% business, 80% business, 70% business, something that just acknowledges like, hey, I do drive my car to the grocery. I do drive my car to church. I do drive my car to the kids' ball games. I do that sometimes. And sometimes just acknowledging that it's, that there's some personal aspect to it, it can be better. The claiming the college credits are completely allowed, and there's nothing wrong with that. But the IRS does match that up behind the scenes with the colleges. So if you are reporting something, I did actually have a client that kept reporting this. He was preparing his own return, came in and had claimed this credit for like 4 years in a row and never went to college. And I don't know if maybe didn't understand that he did, I don't know if there was just a misunderstanding there or what, but the IRS kept, by the time he got to us, he was in a snowball of different letters from the IRS saying, hey, justify your college expenses. So if you're claiming the college credits, make sure that you have a 1098-T, which is a tuition form from the college. And so that would be something to be gathering for tax time, would be if your children are in college or you're in college, you need to look for that form called the 1098-T. The other thing that has to be reported now on the tax return is if you're in Obamacare, which is the healthcare.gov, that has to be reconciled on the tax return. So when you go in to apply for healthcare.gov, you have to tell them how much income you think you're going to have, and they base your premiums on that. At the end of the year, when you file your tax return, all that information is input into your tax return, and it reconciles that to say, oh, I had a little bit more income than I thought I was going to have. So now I don't get as much subsidy or as much help with my health insurance. So I'll have to pay a little bit of that back. Or I made less income than I thought I was going to. So now I qualify for more help on my health insurance. So the return actually won't even file without that information on that form that it's supposed to go into in the tax return. So you absolutely have to have that to file your taxes. So if you're on healthcare.gov, you just want to go to healthcare.gov, log in and get your form called a 1095A, and you'll need that to file your tax return because it will not file without it. But on the same point, as we see here on number 12, if you put the information in wrong, it's going to reconcile behind the scenes and it's going to kick it back. So that would be get you a nice little letter from the IRS on that. Taking early money from IRAs and 401k accounts, especially, it's real common either not to report that or not to report some of the penalties that go with that. Taking an alimony deduction can be a little bit of a, IRS has changed the alimony deduction in that there isn't one anymore for people recently who have gotten divorced, but there are still obviously some people still claiming from before, if before it was grandfather, that they were grandfathered in. But if you took an alimony deduction, then the IRS is matching that up with the other person who's picking that up in income. And so they have to match, or you're going to get a notice on that. So if that's something that affects you, that's just something to be aware of. You can't make up your number. If you don't match with your ex-spouse who's picking that up in income, they're going to kick that back. And then failure to report gambling. Up here in Ohio, we have casinos now. If you don't report that as income, all that gets reported to the IRS behind the scenes. So you need to make sure that you are picking that all up in income. Same thing with like lottery winnings and things like that. So that can be a bit of a flag. Operating a marijuana business, I don't know if that's legal down there in Florida, but up here in Ohio, we now have the ability to have medical marijuana. And so the IRS, as you can imagine, is carefully looking at those because there's a confusion between the federal law and the state law, and marijuana is actually not federally legal right now. So if you have a marijuana business, not that anyone here does, but if you did, it's just income that you pick up from it and no expenses. You can't deduct the expenses. Day trading, which would be a lot of stock sales, things like that. R&D credit, crypto, virtual currency transactions. The IRS has really got their eye on those right now. They're going to, they put into place some rules that's going to have to be reported by those companies that are having people participate in the cryptocurrency. Failure to report foreign bank accounts can obviously be something, not reporting your business. And then also there's something called foreign income exclusion. So these are just things and I know probably for most people, these don't affect anybody, but if they do, if it's something you're dabbling in, just something to be aware of, that those could be something that the IRS would look at. So then I guess to wrap everything up here, you look at all this and you say, well, do I really even need an accountant to prepare my taxes? And the answer might be, honestly, maybe not. If you just truly are just a wage earner, have no interest in dividends, capital gains, just a W-2, maybe you are okay to prepare your own. But there are certain situations where it really could be beneficial to have an accountant, where you could really get some good advice. And I always think you should surround yourself with a professional team like Kelly, an accountant, or a lawyer, and make sure that you have a team of resources that you can look at to get help. But if you own a business or a farm, definitely a good idea to have an accountant. They'll be aware of all the tax law changes. They'll be aware of what you can deduct. If you have investments, such as stocks, bonds, things like that, someone like Kelly can guide you as to when it might be a good time to sell those or buy those, or IRAs, annuity products, whatever it might be, name your thing. But if you're getting advice from someone like Kelly, and you might want to know, how does that impact my taxes? Because sometimes that will, then it's a nice idea to have an accountant to help you guide through that. And even better if your accountant and your financial advisor kind of work together as a team before you pull the trigger on something that you maybe know the tax impact of all that. If you're close to retirement, always a nice idea to make sure you know what kind of income you're going to have coming in after you retire, how that's going to affect your taxes, how much to withhold, that type of thing. Those are sometimes hard waters to navigate without an accountant, if you're not that familiar with taxes. If you inherit money, sometimes there's some nuances to that. Maybe you need some help with some of that. And then if you don't use computers, handwritten tax returns really just kind of a no-no anymore, honestly. So if it's not something you know how to get onto the IRS website and do, or you can't do yourself, then you truly might want to have an accountant for that. So with that, I'm gonna leave it with that. Here's my contact information. If someone did want to give me a call, they would be welcome to. We're not right now accepting new clients at the office. We're kind of got a moratorium on that, but I am glad to receive a phone call if you have a question. And Kelly also has my email if you would like to shoot me an email. With that, Kelly, we can open it up to questions, or what comments or anything that you guys would have that I could help with.
Perfect. That was excellent stuff. If you want to go ahead and stop sharing, I'm going to bring up my other screen here and kind of our end of the seminar type thing. But this is exactly why I wanted to bring you on, because you know my view on this. You don't go to what's that old saying? You don't go to a gunfight with a knife. I don't ever want to have to be the person to have to look at the IRS and say, yeah, here, I know what I'm doing, because I don't. This is the area that I feel is your expertise. And I love having you in my corner. I love having you I don't even know how often I bug you and say, hey, because even for my clients, if I run into a question that I feel is outside of my expertise, I'll give Stephanie a call and say, just wanted to bounce this around, not trying to make the decision for the client, but I just want to understand it better, because I don't ever want to lead them in a direction or even give them inclination that could hurt them. So she is a valuable resource, and just absolutely a beautiful person also. So we did have a couple questions. How do you know, and Stephanie, maybe you can kind of just give a real quick synopsis on this. How does a person know when, hey, I'm to that line. I could still try and do my taxes, but how do I know when I'm to that point where I need to make that leap and find someone? Is there like a defining thing that kind of puts them over the edge to say it's time to get that accountant?
Yeah, I would say if you find yourself Googling and trying to figure out things about your taxes, if you find yourself wondering, like, I wonder if I do this, or I wonder if I do that, what would that affect? You're probably at the point where you need an accountant, honestly. And sometimes having an accountant isn't like, this thousands of dollars a year thing. For most individual people, just depending on your area, you're maybe looking at $300-400, honestly, per year, maybe even less, just depending on your area. So it's not something, that you're more than likely going to get your money back on that at some point, just by the decisions that you're making and just by the security of knowing that your stuff is, that your things are filed properly. So I think it's just important. And again, if you just have wages and you just literally, are just that's what you got, there's really no reason you can't be doing something on your own. But when you find yourself asking these questions of, well, I wonder if I should convert my Roth IRA this year. I wonder how much it would save me if I did that, contributed to an IRA this year. I wonder what would happen if you're retired. Maybe, I think I want to buy a car. I want to withdraw $20,000 from my IRA. I wonder what that's going to do to my taxes. When you start asking yourself those questions, that's the time that you're needing help, with something. And honestly, sometimes truly, it just helps to have someone to brainstorm with, to say, what do you think would happen if I did this? You know what I mean? And sometimes it becomes obvious when you get the answer. Sometimes someone will call in and say, what happens if I do this? And I'll give them the tax number, and they're like, oh God, no, I'm not doing that. Or they're like, oh, that's not so bad. I think I can do that, but at least you have someone to kind of bounce it off and just, you don't feel like you're always making that decision on your own, along with your financial advisor. Maybe Kelly's advised you to do something and you think, oh, wonder how that affects my taxes. It's just nice to have somebody that you can bounce that off of. And then, like I said just a bit ago, it's even better if your accountant works with like your financial advisor, like Kelly, to just kind of work together. And Kelly says, hey, I'm thinking of, I'm advising this person to do this. Can you give us some guidance on what that does for their taxes? So it's just nice to have that resource.
Yeah, that's well said. And I can't even tell you how many times I know, Stephanie, how I've said, I'll say that one more time.
And that's perfectly okay, honestly, because sometimes we just need to either hear it a different way or absorb it, or repeat it. Because some of the stuff is not stuff we deal with all day long. And just some of the stuff that Kelly deals with is not something that I would deal all day long with either, and so I would have to hear it a couple times sometimes just to understand it. And there's nothing wrong with that. And if you're not with somebody that can, give you that patience, then you maybe don't have the right person, quite honestly. So
another question we have is the $25,900 standard IRA deduction an example of what the actual amount is now?
yes. So let me grab my cheat sheet here. But so I gave the example of a couple, which was $25,900, but there are actually different kinds of deductions that people could be filing as. So for example, you might be single. Okay. So let me go back. The $25,900 is the amount for 2022. When you're getting ready right now to file your 2022 taxes now by April 18th this year, that is the actual amount, $25,900. That is the number for a couple. But for a single person, it is $12,950. So if you're single, you won't get as much as a couple. You're only one person, so you're going to get $12,950. There is another classification called head of household, which is where you are providing you're single, or you've lived apart from your spouse for over 6 months, but you're providing a home for a child, for a dependent. And so that's called head of household. It means you're providing a home for a dependent. That deduction is going to be $19,400. And then if you're married, but you want to file separately, then obviously you don't get the whole $25,900 on your return because you're only one of the two. So you're going to get $12,950. But that example of the $25,900 is a real life example of 2022's taxes for a married couple. But it might just depend on how you are filing, whether single, head of household, married filing separate, things like that. So.
Okay. And then I think we've got time for another question real quick. And Stephanie, not to put you in a hot seat, but the question is, how do I go about looking? Obviously, you're kind of booked right now and you're in Ohio, but how do they find the right accountant? What should they look for?
One of the best resources that you can get is a referral from your friends and family, because people have to trust, and I know Kelly runs into this too, you have to trust the person that you're working with. You have to trust that they're going to guide you right, that they're ethical, that they're going to have good advice, that they're knowledgeable. And so if you have friends and family who are using a certain person for taxes, for financial services, for whatever it might be, they are actually probably your best resource, because they're not going to refer somebody to you that is not good at what they do. I'll give you an example. A couple of years ago, I had somebody that was cleaning my house, and she was very cheap for cleaning the house, but she was really just not a good housekeeper, to be honest with you. I hate to say this, hopefully not on here today, hopefully, but but the thing of it is, when people would ask me, okay, I'm looking for a housekeeper, who would you recommend? I could never recommend her, because I knew in my heart that she just really wasn't very good. And so, but she was cheap, and it got the job done. But the thing of it is that's not always going to give you the best result. And so I do actually have a different housekeeper now who does a fantastic job, but she's double the price. But my point of that whole story is, people will not refer you someone that they do not think is doing a good job for them, that they do not trust. So the first place to start would just be in your circle, your family, your friends. Who are you using? Who does a good job for you? And that's your first resource, honestly, because they won't refer you somebody that's not doing a good job for them. Well, and then most likely local to them too, as well. So
yeah, that is great advice. Great advice. And I will say this, Stephanie's not local. Although anytime you want to come down to Florida to help me with my taxes, you are always welcome. But she was my accountant when we were in Ohio, and she was willing to keep us on as clients. And fantastic, because she does a great job. She knows my financial situation. She knows, where we're at. And, it's just nice to know you get that person in your corner. The benefit to having an accountant is knowing you always have that expert in your corner to have your back. Right. If you've got those questions, or if you get that letter from the IRS that you're like, oh man, I don't know what this is, Stephanie.
That's right.
So, excuse me. Any other questions? Any other comments anyone has? Stephanie, the comments have been great, great information. Thanking you. You're a fantastic teacher. You present so clearly. So yeah, great.
Very good.
Comments.
Very good.
So, very good.
Well,
if you check out, I'm going to post in our question and answer. I'm going to switch screens here. I think I'm still set up to do that. Boom. Scan the QR code for your free gift. Stephanie went over some amazing information on red flags, on what might cause you to get selected to have a nice conversation with the IRS. We wanted to make sure that you had that as a takeaway. So just so you could peruse that at your own. And then also she gave us the article where that information came from. So she made it so simple for us. We've got the bullet points and then the article to kind of explain it all just a wee bit better. So if you click on the QR code, you can go and grab that free gift and just have that saved in your computer. So hopefully you never, ever, ever need it, but it's there if you want to just have that information. And then also in our QA, we are going to put, there it is, the free gift also. So if you don't have a QR code that you can scan, the link is right there in the question and answers. So I thank you all for joining us today. I hope you took away at least a little nugget of information and that we made your day just a little brighter, and that you go out and you have a great day and be golden.